Shares of Tesla are up 38% over the past month as I'm recording. And a lot of these gains have come as relatively weak news has come out of Tesla. Second quarter deliveries were down 5%. Production was down. I think we should expect that margins are going to be down again in the second quarter, and revenue is going to be down as well. So where is all the excitement coming from? Well, a lot of it was driven by the excitement for the robotaxi event that was going to be happening in August. That has now been delayed until at least October. Elon Musk confirmed that this morning as I'm recording. And it seems like there was a bit of a short squeeze that happened. So when short sellers are short of stock, to close that position, they need to buy the stock back. When a stock starts rising, it can cause those sellers to basically panic and have to close that position. And that can actually add fuel to the fire on the way up. But I think it's important to look fundamentally at what Tesla is doing, because their businesses are not necessarily trending in the right direction. I talked about EVs already. The autonomous vehicle business, I think, is more up in the air than ever. It's not likely that we're going to see any sort of robotaxi business for at least 3, 4, 5 years. Even analysts on Wall Street are starting to question whether there's going to be any scale to that business by 2030. And then even if you look at the energy business, that is a business that's now driven primarily by subsidies. So if those subsidies don't last, or competitors start flooding into the market to take advantage of those subsidies, that's going to be a point of weakness for Tesla. So I'm going to go through all the numbers that I think investors should at least know and consider with their position in Tesla. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now, before we get too far, I do want to put the valuation metrics out there. And this is on a trailing basis because these are the numbers that we actually know. So on a trailing basis, price to earnings multiple is 66, and the price to sales multiple, the enterprise value to sales multiple, is 8.2 according to FinChat. So very expensive stock. A lot of growth being priced in for Tesla. So what's actually happening? This chart is the one that I think all investors in Tesla should have seared into their minds. In 2022, the company generated automotive gross profit of $20.4 billion over the past year. That has dropped by 25% to $15.0 billion. At the same time, revenue is falling. And this is as of the first quarter numbers. We don't have full financial results for the second quarter yet, but it's likely that given these delivery numbers that you can see, we are going to have another quarter of negative revenue growth. What is going to ultimately turn that around? And I think this is really the question. The Cybertruck in 2023 and 2024 was really supposed to be the catalyst for the next phase of growth for Tesla. That has not been the case. That has not been a vehicle that they've either produced in big numbers or have sold in big numbers. And that's coming out in the numbers. I mean, you can see from the delivery numbers that deliveries are down 5%. If the Cybertruck was a hugely popular vehicle, you would start to see that going up. Traditional automakers are actually seeing their sales start to rise, and they're also increasing their sales in electric vehicles. So the trends for the auto business just aren't moving in the right direction, and at the same time, the stock continues to skyrocket. So this is one of those things that always has me scratching my head. What in the world is going on? I did a video recently about the fact that there was a delay again for the robotaxi announcement. That is another one of those products that Elon Musk has been talking about for nearly a decade and is still not come to fruition. I question whether Tesla is ever going to have a significant robotaxi business, because at the end of the day, I don't think they have the right business model for this. Selling a vehicle to an average consumer, having them pay for FSD if we ever get to a level 5 full self-driving, and then asking them to actually create the vehicle network like you're an Uber, is, I think, just a crazy proposition. I don't think people are actually going to do that at scale. But we'll maybe be able to answer that question if they ever get to the point where they can actually launch a full self-driving vehicle with level 4 or level 5 autonomy, which again is likely multiple years away. So what's the one business that is actually doing really well for Tesla? That's actually the energy business. And I want to dive into that a little bit here. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I want to start with a look at the energy storage business. This has really been one of the highlights for Tesla over the past couple of years, and you can see that there has been phenomenal growth in energy storage revenue, but there's also been a sharp increase in gross profit. So the profitability of energy storage is improving. One of the things that I think, for those of us who have been following the energy industry for a really long time, this doesn't necessarily make sense because energy storage is really a commodity, and Tesla is not really producing its own batteries in the sense that they're buying a lot of their lithium ion batteries off the shelf from a lot of other competitors that are also making energy storage products. So why is Tesla generating such a strong margin? The answer in part comes down to this section right here. This is in Tesla's 10K filing for the full year of 2023. Pursuant to the IRA, the Inflation Reduction Act, sections 48, 48E, and 25D of the IRC, standalone energy storage technology is eligible for tax credit between 6% and 50% of qualified expenditures, regardless of the source of energy, which may be claimed by our customers. So not claimed by Tesla, it's actually claimed by their customers for storage systems they purchase or arrangements where we own the system. These tax credits are primarily for the benefit of our customers and are currently scheduled to phase out starting in 2032. So there are a number of different ways that this is going to impact Tesla. If customers are buying a Powerwall, which is going to be sold into the residential solar market, there are subsidies that go along with that. You can get a 30% tax credit for the cost of that installation. There are also utilities that are giving rebates based on installing energy storage. So you can get thousands of dollars worth of rebates. What that does is ultimately allows Tesla to charge a higher price, especially in the short term, even if they aren't directly collecting those subsidies. So if you're getting a subsidy of $3,000, let's say, to install a Powerwall, and that Powerwall costs $7,500, you're going to get that directly off your bill. In a normal competitive environment, maybe you wouldn't buy that Powerwall if it cost $7,500. It would now have to cost $4,500 for that to be competitive for you. So Tesla is able to benefit from that margin. We're seeing the exact same thing happen with First Solar, where they're actually collecting a lot of the benefit that their customers are seeing because they're the ones supplying the solar panels and indirectly causing and creating the impact that gets that subsidy to their customers. So there's a lot that goes into this, but this is really the reason that margins have increased. Now, the question that I have for investors, and this is after following the solar industry for the last 15 years or so, is this sustainable? And the answer typically is no. Even these subsidies, even these margins that are caused by subsidies are eventually eroded away by competitors moving into the markets where they can get the subsidies. So other companies coming in and offering energy storage in the US, where there's subsidies for creating products in the US, competitors are going to come in and capture those same subsidies that Tesla is getting. If they're building a new plant, they may be even able to build it for a lower cost than Tesla was when they were originally building some of their manufacturing capacity. So typically there's kind of a bubble of excess profit that you get when these subsidies go into effect, and over time, those profits erode to more of a normal market profit for a commodity product like energy storage. And I think that's ultimately what we're going to see happen with the energy storage business. That growth rate is going to slow and those margin expansions are going to slow as well. It's going to be a lot like the electric vehicle business, which had a boom in 2020, 2021. Once you hit 2023, those margins started to erode and you hit more commodity type margins like you have for major automakers. So this is something that's going to happen over and over again. A lot of investors are putting a lot of value in products that don't actually exist yet. But those two products that do exist, electric vehicles and energy storage, I think we should question what the growth trajectory and what the profit trajectory is for them long term, because investors are paying a lot for Tesla stock on the assumption that one of these products is going to explode in growth. Maybe it's Optimus if you think that's the product that's going to explode, or robotaxi, which again doesn't exist yet. But for the company that we know today, Tesla is extremely highly valued. And outside of the energy business, which I don't know how long those subsidies are going to last, this is not necessarily a business heading in the right direction. So I don't think that the pop is justified. And I definitely think as earnings come out over the next few quarters and we start to see what reality looks like for this business, shares are going to start coming down. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.